Welcome to the Deep Dive, brought to you by Talk Tickers. We're your guide for, well, cutting through the noise of earnings calls and getting straight to what really matters.
That's right.
Today, we're taking a deep dive into Alpha Metallurgical Resources, AMR, and their second quarter 2025 results. We're going to unpack the key numbers, dig into the operational wins, which were pretty significant, and explore what it all signals for the company and, frankly, the broader met coal landscape.
Definitely a lot to talk about there.
So Alpha Metallurgical Resources, they certainly presented an interesting picture with Q2. Got the market's attention, but maybe not entirely for the top line reasons.
Yeah, that's a good way to put it.
While the revenue, it landed around $548.7 million, which was actually a bit below forecasts, and a noticeable decline year over year from Q2 2024.
Right.
But the real story here, I think, was the operational performance. The company reported a GAAP EPS of negative 0.38 cents.
Negative 38 cents, yeah.
Which sounds bad, but it was actually a significant beat against what the analysts were expecting.
And that's what's really fascinating about how the market reacted. It really latched onto that EPS beat, kind of ignoring the revenue miss for a moment.
Exactly.
So that negative EPS, it means a net loss per share, obviously, but beating expectations like that, especially in a tough market, well, that's seen as a win.
A definite win in context.
And the adjusted EBITDA, stripping out the one-offs to see the core operational profit, that saw a huge jump. Went from just $5.7 million last quarter up to $46.1 million.
Wow, yeah. That's quite a swing.
Huge swing. And that immediate positive stock reaction, it just signals investors are focusing hard on that underlying efficiency, the financial discipline, even with those broader market pressures.
It suggests they're looking past the immediate revenue number and valuing the operational improvement.
Precisely. They see a company getting its house in order.
Okay, let's unpack this a bit more then. Because the core of Alpha's strong quarter, it really does seem to lie in that operational efficiency. Management, on the call, they highlighted what they called world-class execution. Strong words.
Very strong.
And that apparently led to a pretty dramatic reduction in their cost of coal sales. We're talking more than $10 per ton down compared to Q1.
Yeah, it brought it down to $100.06 per ton for the met segment specifically.
$100.06. And that's their best cost performance since 2021, right?
That's right. Best in several years. So what drove that?
Well, you touched on it. It seems multifaceted. But the key levers, they pointed to a big 10% increase in tons per man hour.
That's significant productivity gain right there.
Huge. And that was coupled with lower labor costs and, interestingly, reduced repair and maintenance spending.
So getting more coal out per worker, possibly optimizing staffing, maybe less overtime, and spending less on keeping the machines running.
Exactly. It suggests maybe better preventative maintenance or perhaps just, better negotiated deals on parts and services.
It hints at a more strategic approach, not just slashing costs randomly, but it does raise that key question. How sustainable is this? Can they keep costs this low?
That's the million-dollar question, isn't it? Management indicated these changes are, fundamental to how they operate now. They sounded pretty optimistic about maintaining this kind of run rate.
Okay.
They did admit, though, that some of the lowest hanging fruit, the easy wins, have probably been picked.
Makes sense.
But they also emphasized there's still a land of opportunity for more optimization. So it sounds like continuous improvement is the goal.
Right. Maybe looking at tech or deeper supply chain tweaks, things like that.
Could be. And we also saw their SG&A expenses, that selling general administrative costs, excluding the non-cash stuff, they also decreased, down to $11.9 million for the quarter. Another sign of that discipline.
Yeah, controlling the overheads too. And it wasn't just about cutting operational costs, was it? Their whole financial picture seems to have brightened considerably.
Oh, absolutely. As of June 30th, their total liquidity, it hit a really robust $556.9 million, which is up nearly 15% just from the end of March. That includes a big chunk of unrestricted cash, $449 million, plus another $182.9 million in unused ABL availability.
So plenty of cash on hand and access to more if they need it through that asset-backed line.
Exactly. Lots of flexibility there. And their cash from operations saw a healthy jump too, up to $53.2 million from only $22.2 million in Q1.
That's a serious improvement in actual cash generation.
It really is.
And if you connect that financial strength to the bigger picture, well, it allowed the board to restart the share buyback program.
Right. On an opportunistic basis. It had been paused for, 5 quarters?
About 5 quarters, yeah. So turning it back on now, that's a pretty significant signal. It says, we're confident in our cash flow, we think our stock's a good buy, and we're committed to returning value to shareholders.
This is a strong message of confidence, definitely. And building on that, management updated their guidance for the full year 2025.
Reflecting these efficiency gains, presumably.
Exactly. They lowered the full year cost of coal sales guidance quite a bit, down to a range of $101 to $107.7 per.
Okay, locking in some of those Q2 savings.
Seems like it. And they also reduced the SG&A guidance to $48 to $54 million and actually increased their net cash interest income guidance. Yeah. So better cost control and earning more on their cash.
All pointing towards improved profitability, even if the market price for coal stays challenged.
Precisely.
Now, thinking longer term, there's that Kingston Wildcat mine development. That seems pretty key strategically.
It does. This new low-vol mine, it's apparently nearing the final stages. They expect initial production, initial shipping, maybe by year end.
Okay, so coming online soon.
Yeah, and this is crucial because it's not just about cutting costs on existing operations. It's about future volume growth, adding optionality.
And they describe the coal from there as a premium product, right? So potentially better pricing, too.
That's the idea. It's a structural investment, looking beyond just the current efficiencies.
Right.
But we have to acknowledge, despite all these internal improvements Alpha's making, the external market for met coal still facing some pretty serious headwinds.
Yeah, definitely a tough environment out there.
We heard talk about depressed steel demand globally, lackluster economic growth forecasts, the usual suspects, plus ongoing trade uncertainties. And the benchmark prices, those met coal indexes like U.S. East Coast High Vol A and B, they actually hit multi-year lows recently, levels not seen since, spring 2021?
Spring 2021, yeah. So prices are really under pressure.
Very much so.
But despite that challenging backdrop, Alpha was quick to emphasize their strong balance sheet and that newly improved cost structure as their key defense, their differentiator.
Right, playing to their strengths.
They're actively watching global supply disruptions and also the potential impact of what they call Chinese involution measures.
Involution measures. Can you clarify that a bit?
Yeah, it basically refers to China kind of turning inward economically, maybe belt tightening, internal adjustments, which could really impact global demand and the whole supply-demand balance for commodities like met coal.
Ah, okay. So internal Chinese economic shifts.
Exactly. And looking ahead to their own contracts, for the 2026 domestic deals, they're apparently focusing on getting prices that can sustain the business over the full year, not just chasing volatile spot prices.
A more stable long-term view then.
Seems like it. They also mentioned that demand from customers in India and Brazil remains strong, which is good news. No negative feedback on trade tensions there.
That's encouraging diversification.
And they also don't anticipate much disruption from that proposed Union Pacific-Norfolk Southern rail merger, given their current regional footprint. So logistics seem relatively secure for now.
Okay, good to know. Now, speaking of the future, this is where it gets really interesting, I think. There was that legislative development.
The critical mineral designation.
Exactly. That bill signed into law, designating metallurgical coal as a critical mineral. What does that actually mean in practice?
Well, the big practical impact is that met coal produced between 2026 and 2029 will be eligible for a refundable tax credit.
A tax credit? Okay, how significant are we talking?
Potentially very significant. Alpha's preliminary analysis estimates this could mean an annual cash benefit, actual cash back, of somewhere between $30 million and $50 million a year.
$30 to $50 million just from this tax credit.
That's their initial estimate. Think about that.
Yeah.
In a volatile commodity market, this basically acts like a government-backed floor under their profitability for those years.
Wow. That could fundamentally change their financial picture and how they compare to competitors, couldn't it?
Absolutely. It's a potential game changer, a unique structural advantage, almost like getting paid a bonus just for producing their core product.
Okay, so pulling this all together, what does this mean for you, the listener, or maybe watching this sector, or Alpha specifically? It seems Alpha's Q2 results really underscore this clear strategic pivot. They're focusing intensely on operational discipline, financial resilience, and those impressive cost improvements, the updated guidance. It all signals that management is actually converting that strategy into real cash flow.
Yeah.
Which is absolutely crucial given how tough the met coal pricing environment is right now.
Spot on. They're not just waiting for the market to save them. They're actively making themselves leaner and tougher, regardless of the market cycle.
Right.
And while those market conditions are definitely still challenging, these efficiency gains, that strong liquidity position, it gives them a pretty substantial buffer compared to some peers who might have higher costs.
True, they seem better positioned to weather the storm.
And then you add in the Kingston Wildcat mine development, that's the future growth catalyst. It shows they're thinking beyond just cost cutting, looking at structural improvements, adding that optionality to scale up later.
So looking ahead then, what are the key things to watch?
Well, definitely continued progress at Kingston Wildcat. Getting that mine up and running smoothly is key.
Okay.
And the potential for even further cost optimization. Can they actually get that cost of coal sales consistently below the $100 per ton mark? That would be a huge milestone.
Sub $100. That'd be impressive.
Very. Then there are the outcomes of those 2026 domestic contract negotiations. That'll set the tone for pricing.
Crucial negotiations, yeah.
And of course, keep an eye on export demand shifts, especially from places like India and Brazil, and any ripple effects from rail network changes. These are all potential drivers.
Lots to keep track of. The big question really seems to be, can they sustain these low costs, maybe even push them lower? And what does that mean for their profitability going forward?
All right, let's shift gears a bit. For those on the theoretical investment committee or just curious how this analysis might translate into a potential trade idea, remember, this is absolutely not financial advice.
Definitely not financial advice. Just a thought exercise.
Exactly. So here's a thought on Alpha Metallurgical Resources. You've got this best cost performance since 2021, right?
Mm-hmm.
You've got the very real potential for getting those costs under $100 a ton. Plus that significant critical mineral tax credit kicking in from 2026 onwards.
That $30 to $50 million boost.
Right. So maybe consider a longer-term play, perhaps structured as a forward spread. You could think about going long, say, a 2026 call option.
Okay, a call option gives you the right to buy later.
Right. Not the obligation to buy shares at a specific price, the strike price, by a certain date. Let's say maybe $160 strike price for 2026.
So you're betting the stock goes well above $160 by then.
You're betting on that continued cost discipline, them really embedding this lean production model, capturing that tax credit benefit fully, and maybe getting some help from an eventual rebound in met coal prices.
Okay, that's the long side. How would you hedge it or finance it?
Well, to potentially finance part of it and maybe hedge against some near-term market jitters, especially with the board restarting that opportunistic share buyback.
Which could provide some support for the stock price.
Exactly. You could consider selling a near-dated put option, maybe a Q4 2025 put with, say, $130 strike.
So selling a put means you're betting the stock stays above $130 in the shorter term.
Correct. The assumption is that the current positive momentum, the cost story plus the buyback, creates something of a floor around that level for the next few quarters.
Makes sense.
The big risk, of course, is a really prolonged, deep downturn in met coal prices that just overwhelms even these impressive cost savings.
Right. The market risk is always there.
Always. But the potential reward side is looking at a company that seems to be seriously retooling its whole operating model for more sustained profitability, even if the market stays tough.
An interesting, albeit theoretical, structure. So just to summarize our deep dive today, Alpha Metallurgical Resources, they delivered a really powerful Q2, defined by that exceptional cost control, rock-solid balance sheet.
Yeah, a performance that definitely resonated with the market, despite those external headwinds we talked about.
Their focus seems unwavering now on operational efficiency, but also those strategic long-term moves like Kingston Wildcat.
And that potentially game-changing critical mineral tax credit coming down the pipe, it really positions them quite skillfully to navigate the ongoing market volatility.
This disciplined approach, it really does appear to be setting the stage for, well, significant future financial resilience, maybe even a unique competitive edge.
It certainly looks that way. They're building a strong foundation.
Well, thank you for tuning in to this deep dive from Talk Tickers. And just one final reminder. The insights we shared here, they're purely for informational purposes.
Definitely not financial advice. Please do your own research.
Absolutely. We always welcome your feedback and any further questions you might have.